When June 12th arrives, the largest stock market debut ever begins trading. SpaceX enters the public market carrying the highest valuation any company has ever brought into its first trading session. And somewhere within those opening minutes, the stock will likely surge, maybe dramatically. The second it does, millions of investors will see that move and assume they need to buy before they miss out. But that's exactly where people get into trouble. Back in 2021, Rivian exploded higher on its first day, gaining 22%. Within the following year, the stock dropped 67%. Meanwhile, Reddit stumbled out of the gate, looked disappointing, then rallied almost 150%. The opening day told investors absolutely nothing in either case. So before you let day one excitement make the decision for you, let's examine the numbers most people are ignoring. Let me clarify something right away. This isn't an argument that SpaceX is a weak company. By almost any standard, it's one of the most remarkable businesses ever built. It launches more rockets than entire countries and operates a satellite network reaching over 160 nations. If you're looking for someone to say the company is doomed, this isn't that video. This is about something far more important, understanding the difference between a great company and a great investment at a particular price on a particular day. Those are completely different things, and that gap is where ordinary investors often lose money. Most people never see how the IPO process actually works. They imagine everyone's showing up on the same day and buying at the same price. That's not reality. An IPO is a carefully designed sequence, a machine built to operate in a specific order, and the people who built that machine are positioned at the front of the line. By the time an investor at home clicks the buy button, several groups have already secured their positions. Most of the excitement surrounding opening day exists to distract from that fact. Over the next few minutes, we'll break down that machine step by step. We'll examine what investors are really purchasing, how the valuation compares to the underlying business, who receives the best opportunities, what history suggests happens next, and the risk many retail investors never notice until it's too late. By the end, you won't need anyone telling you what to do. You'll be able to evaluate the numbers yourself. Let's start with the foundation, because everything else depends on understanding it. For years, a company like SpaceX has operated as a private business. Its shares are owned by a relatively small circle consisting of founders, employees, and investment firms that provided funding over time. No matter how interested you were, those shares weren't available in a regular brokerage account. An initial public offering changes that. It's the moment a private company sells ownership to public investors for the first time. From then on, its stock trades on an exchange where anyone can buy and sell shares. SpaceX is expected to trade on NASDAQ under the symbol SPCX, with trading scheduled to begin June 12th. Here's the critical detail that most headlines overlook. There are two separate prices involved. The first is the IPO price. For SpaceX, that's $135 per share. This number is negotiated before public trading begins between the company and the major investment banks managing the offering. Shares sold at that price are allocated primarily to large institutions and selected insiders. The second price is the one most retail investors will actually encounter. When trading begins on June 12th, the market determines the opening price based on supply and demand. In highly anticipated offerings like this one, that opening price often lands significantly above the IPO price. Remember that difference because it's one of the most important pieces of the entire story. We'll return to who benefits from that gap shortly. Before deciding whether the stock is attractive, we need to understand the business underneath it. According to company filings, SpaceX generated approximately $18.7 billion in revenue during 2025. That's unquestionably a large and meaningful enterprise. However, there's another figure receiving far less attention. During that same period, the company reported a loss of about $4.9 billion. Revenue is growing rapidly, but profitability remains a challenge. So where does that revenue come from? Many people assume SpaceX is primarily a rocket company. That's no longer the full picture. The largest part of the business today is Starlink, the satellite internet division. Starlink produced roughly $11.4 billion in revenue, accounting for approximately 61% of total company sales. More importantly, Starlink is the only major segment producing substantial profits, generating around $4.4 billion in operating income. The launch division continues expanding, but at a slower pace. Meanwhile, the company's artificial intelligence initiatives are currently consuming capital rather than generating it. So when investors purchase SpaceX stock, they're effectively buying a business where one highly profitable engine, Starlink, is pulling several other ambitious projects that have yet to prove their economic value.
There's another reason those extra divisions matter. Right now, Starlink is pulling most of the weight while several other segments continue consuming cash. Could those businesses become extremely valuable in the future? Absolutely. But future potential is carrying a huge portion of the valuation, and future potential only matters if it eventually becomes reality. One important clarification before we continue. The reported $18.7 billion in revenue includes the AI division as if it had been part of the company for the entire year, despite joining midway through the period. Remove that contribution and the business becomes even more dependent on Starlink. Either way, the takeaway doesn't change. One segment is responsible for most of the company's economic strength. Now let's discuss the valuation itself. Most headlines will simply tell you that SpaceX is entering public markets at $1.75 trillion valuation and expect that number alone to impress you. But the size of the number isn't the most important part. The speed of the increase is. Go back less than 12 months. During private transactions in mid-2025, SpaceX shares were changing hands at a valuation close to $420 billion. By the IPO, that figure has climbed to $1.75 trillion. That's roughly a 4.2-fold increase in about 11 months. Naturally, you'd assume the underlying business expanded dramatically during that period. It didn't. Revenue increased by roughly one-third. The rocket business didn't become 4 times larger. The satellite network didn't quadruple. The thing that multiplied was investor enthusiasm. Let's put the valuation into perspective. At $1.75 trillion against approximately $18.7 billion in annual revenue, investors are paying around $94 for every dollar of sales the company generates. 94 to 1. And remember, the company is still posting net losses. For comparison, many large, profitable corporations trade at only a fraction of that multiple. Even high-growth market favorites rarely sustain ratios anywhere near that level for long periods. And this isn't just one opinion. A respected independent Wall Street research firm recently estimated SpaceX's fair value at roughly $780 billion, about 55% below its IPO valuation. Notice something interesting? That estimate sits remarkably close to where private market valuations were only months ago. In other words, much of the surge occurred immediately before public investors were invited to participate. Let's look at Starlink again. It generates around $4.4 billion in operating profit. If investors valued that business generously at 40 times earnings, Starlink alone would be worth approximately $176 billion. Yet the entire company is being offered at $1.75 trillion. That means the profitable core accounts for only a small fraction of the total valuation. The remaining value depends on future opportunities that have not yet materialized. So if the valuation appears stretched, why do IPOs often surge on opening day? To understand that, you need to understand who stands where in line. Think of the $135 IPO price as the starting line of a relay race. The first runners are large institutions and insiders who receive allocations before trading begins. They secure positions at that price quietly behind the scenes. They're standing at the front. This particular offering does contain one unusual feature. In many hot IPOs, retail investors receive only a tiny percentage of shares, often somewhere between 5 and 10%. SpaceX plans to direct as much as 30% of the offering toward everyday investors through major brokerage platforms. That sounds investor-friendly, but remember, Wall Street rarely expands access without a reason. Even with a larger retail allocation, demand is expected to exceed supply by a massive margin. Most investors who want shares at $135 won't receive them. When trading begins, they still want exposure, so they buy at whatever the market offers. And who is often selling into that demand? Frequently, it's the investors who received shares at the lower allocation price. That's how the relay works. Risk moves from early participants to later participants. The opening day surge that headlines celebrate is often nothing more than ownership changing hands from investors who bought low to investors buying much higher. The person sitting at home purchasing after the opening pop may feel early. In reality, they're often among the last people entering the trade. Now that you understand the valuation and the order of participation, we can discuss what typically happens after highly anticipated IPOs, because there's a pattern many investors overlook, and it catches people off guard every cycle.
The real danger isn't simply that the stock might decline. The bigger risk is far more subtle. Shortly after a company like this starts trading, another force often enters the picture. Major index funds, the same funds sitting inside millions of retirement accounts, may be required to purchase shares once the company qualifies for inclusion. They don't buy because they love the valuation, they buy because the rules say they must. That mandatory demand can push the stock even higher during the first few weeks of trading. Think about what that means. If you own a retirement account invested in index funds, and most investors do, you could end up owning a piece of SpaceX automatically at whatever price the market happens to be charging. You never made the decision yourself. The purchase happens whether you agree with the valuation or not. And here's the uncomfortable part. That temporary demand often arrives exactly when early investors are looking for an opportunity to reduce their positions. The elevated price doesn't necessarily protect new investors. Sometimes it simply creates a convenient exit for people who got in much earlier. Underneath all the excitement, the long-term IPO statistics are surprisingly harsh. Research examining public offerings over time found that more than 90% of IPOs eventually trade below their first-day low at some point. Not below their opening high, below their lowest price on day one. More than 9 out of 10 eventually fall beneath the worst level seen during their debut session. Think back to Rivian and Reddit. Rivian exploded higher on its opening day, gaining 22%, only to lose 67% over the following year. Reddit struggled initially, looked disappointing, and later surged almost 150%. The lesson isn't that every IPO collapses. The lesson is that opening day performance tells you almost nothing about future returns. A strong debut feels meaningful. A weak debut feels meaningful. But history suggests both signals are largely noise, and noise is a terrible reason to invest. There's another stage in the process that catches retail investors repeatedly, despite being disclosed months in advance. When companies go public, insiders, employees, and early investors usually aren't allowed to sell immediately. They're restricted by what's called a lockup period, commonly lasting around 180 days. The reason is straightforward. If everyone holding low-cost shares rushed to sell on day one, the stock could collapse instantly. The lockup prevents that. But the shares don't disappear, they're simply waiting. Once the restrictions expire, a wave of new supply can suddenly enter the market, and when supply rises faster than demand, prices often come under pressure. SpaceX has structured its release schedule in an even more gradual way. Instead of one major unlock date, insider shares become eligible for sale through several separate stages. A meaningful portion can become available shortly after the company's first quarterly earnings report as a public company, likely occurring only a few months after the IPO. Additional blocks are released after later earnings reports, with the remaining shares following the more traditional 6-month timeline. The founder has agreed to keep his own position locked for a full year, which sounds reassuring until you realize many other shareholders aren't following the same schedule. Notice the timing. These releases often occur precisely when the initial excitement begins fading. Headlines move on, trading activity slows, retail enthusiasm cools. At that exact moment, additional shares begin entering the market. New supply meets weaker demand. That's a combination that frequently pressures prices lower. And unlike many risks in investing, this one is visible on the calendar months in advance. Picture the process as several waves rather than one. Each wave introduces another group of shareholders who are finally allowed to sell. And each time, the buyers absorbing those shares are often ordinary investors arriving after the excitement has already peaked. Now let's focus on the only question that truly matters. Forget predicting where the stock goes next month. Nobody knows. Not analysts, not financial media, not the loudest voice on social media. Instead of forecasting price movements, let's measure expectations. What would SpaceX actually need to accomplish for purchasing shares at this valuation to make sense? To keep the comparison fair, let's set a surprisingly modest goal. Forget becoming wealthy. Let's simply ask what it would take to outperform the boring alternative, buying a broad index fund and doing nothing. Historically, investors often expect around 10% annual returns from that approach. Starting from a valuation of $1.75 trillion, SpaceX would need to reach roughly $4.5 trillion within 10 years just to deliver that same 10% annualized return. That's the hurdle. Not extraordinary gains, not market domination, simply matching what a passive index investor might reasonably expect over the same period.
Is Andrew Finance, where we go beyond numbers and explore the deeper systems behind money, psychology, and modern living.